Welcome back to Factful Finance, where we dive deep into the world of money to bring you the insights you need to make smarter, more informed financial decisions. Let me ask you something. What do hedge funds and private equity firms actually do? You might have heard their names tossed around in financial news, but when it comes to understanding how they shape global finance, well, that's a whole other story. Today, we're breaking it down, so you can walk away with a clear understanding of their role in the bigger financial picture. Now, you're probably wondering, why should you care? Here's the thing. These two entities control trillions of dollars. That's not a small number. In fact, hedge funds alone manage more than $4 trillion in assets worldwide. They have the power to move markets, influence economies, and even change entire industries. So, understanding how they work isn't just for Wall Street insiders, it's for anyone who wants to be financially savvy in today's complex economy. But first, a quick disclaimer. This content is for educational purposes only. The mention of any apps, products, or services does not constitute an endorsement. Always consult a certified financial professional for personalized guidance. Hedge funds and private equity are both types of investment vehicles, but their strategies, goals, and impact on the global market couldn't be more different. So, let's break it down. Hedge funds are known for their aggressive, high-risk investment strategies aimed at generating quick, high returns. Think of them like the thrill seekers of the financial world. They use a wide range of tactics, short selling, derivatives, leverage, to take advantage of market inefficiencies. Imagine if you could make money whether the stock market goes up or down. That's what hedge funds are trying to do. Bet on both sides of the market to generate a profit. On the other hand, private equity operates with a longer-term vision. Instead of buying and selling stocks, private equity firms typically buy entire companies, often those that are underperforming. They then work to restructure and improve those businesses before selling them for a profit. It's a more hands-on, transformation-driven approach. These firms might help turn around a failing retail chain or a struggling tech startup, bringing new management, cutting costs, and improving operations. So why are they important? Let's look at the bigger picture. Hedge funds and private equity firms have become key players in the global economy because they often hold substantial sway over the financial markets. When hedge funds make big moves, like shorting a stock or betting against a currency, it can create ripples that affect millions of people. Their actions can even trigger market crashes, as we saw during the 2008 financial crisis, when hedge funds played a key role in the collapse of Lehman Brothers. Private equity firms, meanwhile, often shape entire industries. They can drive innovation, or in some cases, dismantle businesses to profit from their assets. For example, private equity has been behind the acquisition and restructuring of large companies like Toys R Us and Hertz. While this can lead to greater profitability in the long run, it often comes at a cost, like layoffs or store closures. But it's not all doom and gloom. These firms also bring value to the market. They provide liquidity, which means they make it easier for companies to get the funding they need to grow. They can also drive efficiency by pushing businesses to operate better, whether that means cutting waste or improving their product offerings. Consider the story of Olivia, a mid-sized tech company owner who was struggling to scale her operations. Enter a private equity firm. They injected capital, revamped her team, and streamlined operations. A few years later, Olivia's company was more profitable than ever, and the private equity firm made a handsome return on its investment. Of course, there are risks. With hedge funds, the focus on short-term returns means volatility, and that volatility can have real consequences for the wider market. As for private equity, while it can revitalize companies, there's the downside of aggressive restructuring that may hurt employees or lead to job losses. Here's the bottom line. Hedge funds and private equity are integral to global finance because they shape markets, drive innovation, and bring liquidity to the economy. They represent both opportunity and risk, and understanding their role gives you a better grasp of how financial systems work and how they impact your investments and industries you care about. So, which one is more impactful? It depends. Hedge funds are fast-moving, market-driven, and often reactive. They thrive on uncertainty. Private equity, on the other hand, is more deliberate and focused on long-term growth. Both have their place in the financial ecosystem, but understanding them helps you navigate a world where financial decisions have far-reaching consequences. What's your take on these powerful players in global finance? Drop your thoughts in the comments. I'm always eager to hear from you. And if you found this breakdown helpful, be sure to like, subscribe, and hit the notification bell so you don't miss out on the next deep dive into the world of finance. If you want to keep learning, check out the video on screen for more insights into the ever-evolving financial landscape. This content is for educational purposes only. Always consult a certified financial professional for personalized advice. Thanks for watching. Until next time, keep managing your money like a pro.